Hi everyone. Welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
In this video, let's take a look at some of the key takeaways from a recent interview of legendary investor Howard Marks with David Rubenstein in October 2023. In this interview, Mr. Marks shares key lessons learned, his investment philosophy as well as future outlook. Let's dive in. Importance of recognizing a sea change. Mr. Marks underscores that a sea change is a pivotal shift in the financial markets that investors must acknowledge. In this context, the sea change he refers to is the changing interest rate environment. For nearly 4 decades leading up to the interview, interest rates had been on a consistent downward trajectory or had remained extremely low. This period of declining interest rates had a profound impact on various aspects of the financial world. During this era, asset owners and borrowers had it relatively easy. Businesses and investors enjoyed a favorable environment, with low borrowing costs, steady economic growth, and extended bull markets. Defaults and bankruptcies were relatively rare, and investment returns were buoyant. Mr. Marks argues that this era of easy money may be coming to an end. Interest rates have started to rise or have stabilized at higher levels compared to the previous decades. This change has significant implications for asset allocation, investment strategies, and overall financial market dynamics. The core message is that investors should not take the current environment for granted but rather recognize that a significant shift is occurring. Acknowledging this shift is crucial for making informed investment decisions and adjusting strategies accordingly. Shift towards fixed income. Mr. Marks suggests that, given the sea change and the expectation of higher interest rates, there may be a shift in investor preferences away from riskier equity-like investments toward fixed income assets. Fixed income investments, such as credit instruments, loans, high-yield bonds, and even private loans for buyouts, have become more attractive because they offer returns that are competitive with equities. These returns can be achieved with a relatively higher level of safety and lower risk. He highlights that credit investments have certain advantages over equities. Credit investors typically receive payments earlier in the financial structure, making their investments less vulnerable to market downturns. In cases of default, credit investors may even gain control of the underlying assets, reducing potential losses. Mr. Marks acknowledges that while some investors might consider parking their funds in low-risk assets like treasury bills to enjoy steady returns, this may not suffice for many institutional investors like pension funds and endowments. These institutions often have return targets that are higher than what treasury bills can offer. Therefore, Mr. Marks suggests that a shift towards fixed income, particularly credit instruments, could be a logical move for these institutional investors in the current environment, where they can potentially achieve their return targets without taking excessive risk. Distressed debt expertise. Howard Marks and Bruce Karsh's innovative approach to distressed debt investing involved recognizing that many corporate bankruptcies and defaults are often linked to maturity mismatches in debt. Companies may struggle to refinance their existing debt when it matures, leading to financial distress. The distressed debt strategy involves identifying opportunities in these financially troubled companies by purchasing their distressed debt securities at a significant discount. The goal is to profit from potential recoveries as these companies restructure or emerge from bankruptcy. Mr. Mark's success in distressed debt investing underscores the value of understanding the credit markets, distressed asset valuations, and the dynamics of corporate financial distress. This approach can be particularly rewarding during economic downturns or periods of rising interest rates when more companies may face challenges with their debt obligations. Investment philosophy and advice. Mr. Mark's investment philosophy is rooted in acknowledging the inherent uncertainty in financial markets. He advises against over-reliance on predictions and forecasts, as these are often unreliable. Instead, he advocates for an investment approach that embraces uncertainty and incorporates risk management. One of Mr. Mark's critical insights is that market prices are influenced not only by events but also by the reactions and sentiments of market participants. This means that understanding market psychology and sentiment is crucial when evaluating investment opportunities. When offering investment advice, Marks emphasizes the importance of tailoring recommendations to individual circumstances. He encourages investors to consider their unique financial goals, risk tolerance, and time horizons. This personalized approach ensures that investments align with an individual's specific needs and constraints. Mr. Marks also highlights the need for humility in investing. He underscores that even the most successful investors cannot consistently predict the future or be right all the time. Accepting this reality and adopting a disciplined, risk-aware approach to investing can lead to better outcomes over the long term.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors. Thanks for watching.